Ever felt like your brilliant startup idea is stuck in neutral because of a glaring lack of funds? You've poured your heart and soul into crafting the perfect product or service. You've got a solid business plan, and you can practically taste the success. But then reality hits. You need capital to scale, to hire, to market, to truly bring your vision to life. And that's when the daunting question arises: where do you find that crucial financial fuel? This is where online lending platforms like Fundera enter the picture, offering a potential beacon of hope for startups seeking financing. But the crucial question remains: can your startup actually qualify for a business loan through Fundera? That's precisely what we're going to unpack in this video. We'll delve into what Fundera is, how it works, the types of loans they facilitate, and most importantly, the eligibility criteria that startups need to meet to have a realistic chance of approval. So, grab a cup of coffee, settle in, and let's explore the world of startup funding through Fundera. By the end of this video, you'll have a much clearer understanding of whether this platform could be the key to unlocking your startup's growth potential. First things first, let's establish what Fundera actually is. Think of it as a marketplace, a matchmaker of sorts, connecting small business owners with a network of various lenders. Instead of you having to individually research and apply to dozens of different banks and online lenders, Fundera streamlines the process. You fill out a single application on their platform, and they then present you with loan options from their partner lenders that you might qualify for. This can save you a significant amount of time and effort. Imagine the hours you'd spend navigating different websites, understanding varying requirements, and filling out multiple applications. Fundera consolidates this, making the initial exploration phase much more efficient. Now, what types of business loans can startups potentially access through Fundera? The platform works with a diverse range of lenders, which means they can facilitate various financing options. Some of the common types of loans you might encounter include term loans. These are your more traditional loans with a fixed repayment schedule over a set period. They can be used for a variety of purposes, from purchasing equipment to working capital. SBA loans, backed by the Small Business Administration, these loans often have more favorable terms and lower interest rates, making them highly sought after. However, they also tend to have stricter eligibility requirements and a longer application process. Business lines of credit. This offers more flexibility, allowing you to draw funds as needed, up to a certain limit. You only pay interest on the amount you actually borrow, making it a good option for managing short-term cash flow needs. Invoice factoring. If your startup deals with business-to-business sales and has outstanding invoices, invoice factoring allows you to get an advance on those invoices, providing immediate working capital. Equipment financing, specifically designed for purchasing equipment. This type of loan is often secured by the equipment itself. It's important to note that the availability of these loan types and the specific terms will depend on the individual lenders within Fundera's network and, crucially, your startup's qualifications. Which brings us to the million-dollar question: what does it take for a startup to actually qualify for a business loan through Fundera? While specific criteria will vary between lenders, there are some common factors that almost all of them will consider. 1. Time in business. This is often a significant hurdle for very young startups. Lenders generally prefer to see a track record, even a short one, demonstrating that your business has been operational and generating some revenue. While some lenders on Fundera might work with businesses younger than a year, many prefer to see at least 6 months to a year of operation. The longer you've been in business, and the more consistently you've operated, the better your chances. 2. Revenue. While profitability is ideal, lenders will definitely want to see consistent revenue generation. They need to be confident that your business has the cash flow to repay the loan. The specific revenue requirements will vary depending on the loan amount and the lender, but generally, the more revenue you can demonstrate, the stronger your application will be. Be prepared to provide bank statements and potentially financial projections. 3. Credit score. Your personal credit score is often a key factor, especially for younger businesses without a long business credit history. Lenders use this as an indicator of your financial responsibility. Generally, a credit score of 600 or higher is often preferred, and scores in the high 600s or 700s will significantly improve your chances of securing more favorable terms. It's crucial to know your credit score and address any negative marks before applying. 4. Business credit score. As your business grows and establishes a credit history, your business credit score becomes increasingly important. This score reflects your business's history of paying its debts. While a young startup might not have a long business credit history, it's something you should start building as soon as possible. Lenders on Fundera will likely consider both your personal and business credit scores if available. 5. Cash flow. Demonstrating healthy and consistent cash flow is paramount. Lenders want to see that your business generates enough money to comfortably cover the loan repayments. You'll likely need to provide bank statements and potentially cash flow projections to illustrate this. A strong cash flow statement shows that you consistently have more money coming in than going out. 6. Collateral. Depending on the loan type, for certain types of loans, such as secured term loans or equipment financing, lenders may require collateral. This is an asset that the lender can seize if you default on the loan. For startups, providing substantial collateral can be a challenge. However, if you are seeking equipment financing, the equipment itself often serves as collateral. 7. Business plan. While not always explicitly requested in the initial application, having a well-structured and compelling business plan is crucial. It demonstrates your understanding of your market, your revenue model, your growth strategy, and your financial projections. If a lender requires further due diligence, a strong business plan will significantly bolster your credibility. 8. Industry and business model. Some industries are perceived as riskier than others. Lenders will assess the viability and stability of your industry and your specific business model. A well-defined and sustainable business model will increase their confidence. In conclusion, can startups qualify for business loans through Fundera? The answer is a nuanced "it depends." Fundera can certainly be a valuable resource for startups seeking financing, connecting them with a diverse network of lenders who may have more flexible requirements than traditional banks. By understanding these requirements, preparing your business thoroughly, and shopping around for the best offers, your startup can significantly increase its chances of securing the funding it needs to thrive through platforms like Fundera. With that said, thanks for watching, and until next time.